Well, welcome back to the On the Tape podcast. There's certain people I look forward to seeing, I look forward to hearing from, just sort of engaging with. Caleb Silver is one of those people. Caleb is the editor-in-chief of Investopedia. See, I pronounced that correctly, by the way. Now, I'll say this. You've been on Fast Money dozens of times. I believe this is the third time you're with us here on the tape, but it is always a joy to have you, Caleb. Welcome.
Thank you. Third-time caller, long-time listener.
It's the best.
Huge fan of you guys. Love being on Fast Money with you. Love being on the pod here with you. And just like seeing you, too. I just feel good when you're around.
Investopedia is an unbelievable platform. So let's take a couple minutes because recently, when I say recently, within the last month or so, you guys rang the closing bell at the NASDAQ to celebrate your 25-year anniversary. And if you know anything about the business, to make it a year is a lot, but 25 years is quite an accomplishment.
Thank you. 25 years on the internet, that's like 250 real years, right? And we have made it through a bunch of bear markets, a bunch of bull markets, political chaos, the rise and fall of various forms of the internet, and we're still happy to be here. But I think we're still here because people are happy that we're here. They're happy to use us. And I can't tell you how much joy and pride I get out of being the editor-in-chief of a place where when I go and introduce myself to people, usually the second thing out of their mouth is, thank you.
Yep.
As if I did it myself. I didn't do it myself. Our whole team has been working on this site for years and years. But just being a place where people are happy you're around and being able to spread financial education, that's a pretty cool thing to be able to do for us as a website, as a company, and for me.
Yeah, aside from being a tremendous resource, so anybody goes to the web, they search some topic, it's very likely that Investopedia comes up here. And so when I think about that, even for us who've been in the markets, Guy, for more than 30 years, me almost 30 years, but you also create a lot of content that's really relevant, I think, to, so it's not the evergreen stuff that exists on the platform. Talk to us a little bit about that, because you've also evolved. You have your own podcast, the Investopedia Express. You talk to a lot of very relevant market participants.
Train horn.
Yeah, right. I mean, right now. So it's not just this thing that lives statically on the internet,
Yeah, we've really had to evolve who we are because we want to be where our audiences are. And they're not just readers looking up a definition, although that was the origins of the site.
Yep.
1999, two guys from Canada, Edmonton, Alberta, both named Corey. Smart dude said, hey, we should put up a dictionary, an investing dictionary, because the internet bubble's happening. CNBC was being born, same with CNN-FN and Bloomberg, and nobody knows what anybody's talking about except these very few people. Let's do that. P.S. There's a company in Mountain View, California called Google. These two guys in a garage are trying to index the internet. If we put up the dictionary, maybe people will point to that. Good idea. By the way, let's also put up some test prep for the series exam. Yeah. So if people want to get into trading stocks and be in that world, they can do it too. That was a really good idea. It evolved. They sold it eventually, went through a couple of hands. It is now in IAC's hands. We are an IAC-owned company through Meredith, which is a big publishing company that includes the assets, which were about.com, and Meredith, which is people, real simple, in style, food and wine, travel and leisure, and all those great brands. We're part of that family, but we've had to evolve what we do. So we do news. I have a podcast. We do video. We're big on the social platforms. I am out and about where I see you guys either on CNBC or on the conference circuit trying to break the wall, the internet wall of what Investopedia was, because we are here for today's educated investor, and we want to be here for another 25 years educating investors about their money.
You will be without question. And before we get into some of the work and get a little granular, Wall Street historically has been a pretty cookie-cutter, homogenous area, group of people, whatever you want to say. Everybody sort of looks alike and sounds alike. You, though, come at this world from a much different perspective, which I think is really refreshing and fascinating. You ride a skateboard, you own a restaurant in California. You're just a really cool effing guy. And I mean that sincerely, and that's high praise. So speak to sort of your background and how you found yourself in, again, this very pasteurized world.
That's very flattering. Thank you very much. And you say the nicest things, and that's why I keep coming back. But also, I am an accidental business journalist in some ways. I grew up in Santa Fe, New Mexico, in the restaurant industry. That's what I knew. Went back there after college, came to Colgate for college, went back to Santa Fe, was working in the restaurant business. But I knew that my North Star, I didn't know what I wanted to be when I grew up, was to be able to use the power of media to communicate and help people, right? That's what I knew I wanted to do. That could have taken the form of many different ways. But for me, it started as making documentaries. So I used my restaurant money to buy a camera, became a documentary maker, became a photojournalist, strung for the news, worked my way through through Central and South America for different environmental groups, went to graduate school here in New York, fell in love, all those things. But then I was a cameraman for Bloomberg in the early days as a second camera or CNBC. So I was getting into this world while at NYU getting my journalism degree and watching this internet bubble start to percolate a lot. And Bloomberg was in its early days. They hired me out of grad school eventually after a year or two to be a segment producer, creating a segment about internet stocks and how to invest in them and how to understand these companies like Yahoo, like Lycos, like Excite, right? Ring any bells?
Yeah, at home. I mean, we can keep going on this one.
All of it, right? Yeah. And so I got into it that way, and I was there for the early days of Bloomberg Television, which were totally fascinating because we were trying to bring the terminal to the broader audience, both institutional investors and retail investors, bring it to life in a way that could show people what was possible through it, even though it's so complicated and expensive. That's what we were trying to do, competing with CNBC, right, as an upstart. But that's how I learned business news. That's how I learned business journalism. That's how I learned the markets. And that's how I found my way in this. And through a couple of, cycles, you'll learn a lot. I've been doing this thing for about 30 years right now. So I backed my way into it as a photojournalist, as a cameraman, and here I am, and that's what I do. I'm trying to keep it interesting.
And you talked about how you've evolved. It's funny, like the core of your offering, like I said, is just a tremendous resource. So when I think about, you go to the site, there's lots of different ways to engage in the content, and it continues to grow. So I think about the period that we're in right now, and Guy and I get pretty excited about it. It's earnings season, right? And so, take it to the bank. Every listed company, they have to report their earnings, 4 times a year, and most of them give guidance going forward. Talk to us a little bit about how does the traffic pick up? How does some of the queries pick up? I know that you do a lot of this survey work, and we're going to get to that in a few minutes here, but what is earnings season like for you guys over at Investopedia?
Yeah, let me take you inside the world of the individual self-directed investor for the most part, because that's who's trafficking a lot of Investopedia. They're looking things up themselves. They may have an advisor or planner or somebody that they work with, but they want to be smart about it. They want to learn. So we've learned over time what they like to learn about. And we also know this. We do news. We do cover earnings, but we're not going to beat the robots to the punch when it comes to getting the first one out there, and we don't care. That's a very short-lived article with a very small amount of traffic. We know we're very good at the explanation. So what does really well for us is not the earnings breakdown as much as the what to expect from. And the key metrics to watch. Why does that work for us? Because that speaks to the educated investor. We're not talking about levels or where the stock might trade, although we might do some technical analysis on that through our chart report, our technical analysis newsletter. But what we're trying to do is try to educate people on the metrics to watch, because when they go into and they read that, especially those that are new to the game, they're learning the terms and what these things mean. So they become a smarter investor, and they become much more interested in the journey of these companies. And then what does really well for us is the second day story, or the bounce story we sometimes call it, which is, for example, Amazon. How does Amazon make money? Now, everyone thinks they know how Amazon makes money, but it actually changes a little bit every quarter in terms of where the money comes from. They want to educate themselves on the fundamentals of the company, learning after the fact, not in a tradable way, but in a way that makes them smarter. So if they're holding or they're considering buying, they know a little bit more about the company. And watching them go through that journey, totally fascinating, but that's also the exciting part. We don't want to do the news like everybody. We want to be the educated, provide news to the educated investor that wants to learn more.
Sometimes, you try to explain to people the economy is not the stock market. And a lot of times what you'll say is, you just have to trust me on this. Believe me when I say it. They're two mutually exclusive things. Recently, though, you don't have to explain it to people. It's happening right before their very eyes. We have a stock market through the S&P 500 at an all-time high, and this administration's approval rating when it comes to the economy effectively at an all-time low. How does your work how do you wrap your head around that? Because it's as distinct as I've ever seen.
Yeah, no, it is a tale of two countries, and it's a K-shaped economy, all the different metaphors you want to use, because those that are in the investing class and those that have assets are doing very, very well and have been for quite a while, but especially over the past few years, while a lot of other people just don't feel it. All they feel is higher prices for insurance, higher prices at the grocery store, higher prices for healthcare when they go to, try to take their family on a vacation. And you could see that in our traffic as well. Figure 10 to 15 million people coming to Investopedia every month, all with a very distinct question. Not everybody's looking for the same thing. People are asking very different questions. So I was just looking today at what people are looking for. And you have people who are playing earnings, and you could tell they're looking for the what to expect stories, and Tesla and everybody else, and they're looking through that. But there are also other people who are looking at different ways to tap their 401ks for a loan if they need to, where to get a hardship loan, best personal loans to take right now. And then there are other people saying, I can see interest rates going down. I can see the high yield savings accounts numbers going down and the CD numbers going down. Should I lock in today? Right? There's all kinds of people coming in with so many different questions, but it paints this mosaic of pretty much the entire country, if not the entire world, of what they're looking for.
We obviously are watching every tick every day, and then we're commenting. We're recording podcasts during the day. We go do Fast Money after the close. There's kind of news breaking after then, so we have to kind of be really quick. You know what I mean? To kind of give our 2 cents here. When you think about some of the places that folks are going to get some of this analysis, get some of this kind of breakdown of these stories. Do you guys get to see like how these queries change, what people are most focused on? You do a lot of that survey work, but that I think is obviously you're going out to your listeners, to your readers, to your viewers, that sort of thing. How are you guys monitoring? Like here's a good example. Okay, so about 3 weeks ago, I think the investment world was fairly well convinced that the Fed had set out on a rate cutting cycle. Okay, rates had come down fairly dramatically. If you look at the 10-year, which is obviously not so closely tied to Fed funds, but it's more directionally, right? We had a 10-year at 5%, I want to say months earlier. And by the time they cut, the 10-year was at what, 4-ish or something like that? Does that make some sense?
Traded almost down to 3.5%. So a huge move, obviously.
And now here we are. We've rocketed back to 4.25. I have to assume if you're a stock market person, and let's say you don't know a lot about the bond market and how treasury yields and how Fed funds rate affect, the stock market, and now it's been so uncertain. Are you guys seeing that data? Are you seeing people getting turned around? And how do you kind of report on that also?
Yeah, well, you see that in just what people are searching for obvious reasons, whether that is locking in a high yield savings account at a certain rate or wondering why mortgage rates are creeping up again and home buying is slowing when we thought we were entering a period of finally the ice cracking on the home buying market. But that's not happening. So people are wondering that. How do those yields work, right? How does the Fed funds rate actually affect yields on the Treasury? That is a question that people ask on Investopedia hundreds, if not thousands of times, especially when they don't know what's going on. We have this other thing that we've had for years called the anxiety index. And this measures people's anxiety based on the queries they're making around anxiety-based terms around the stock market, the economy, and personal finance. I think I've talked about it here before, but that is really interesting because that measures a very tracked set of keywords, about 18 of them in those categories. And when people are looking for bear market, when they're looking for correction, when they're looking for reversal, we can see the temperature really of investors and their anxiety based on that. And guess what? They've been a little bit more active and a little bit more anxious lately, but relatively chill as this market has just grinded higher to new highs after new highs. And we talk about the sentiment survey. That's when we're literally going out and asking our newsletter readers. We have 1.5 million daily newsletter readers and a pretty good open rate there. We're asking them, what are you bearish about? What are you bullish about? What are you most fearful about? What do you think returns are going to be 3 months out, 6 months out, a year out? What would you do with an extra 10 grand? We talk about it on Fast Money when I come on all the time. And that is fascinating too. They're as optimistic as they've been in a long time, maybe a little bit late to the optimism because it took a long time to get there, but certainly as optimistic as they've been in a while, even with the election getting closer and closer.
Let's talk about the election because there are all kinds of betting markets on the back of this election, more so now than probably ever, that we've ever seen. I guess my first question is, and not to be political, but what are people's concerns around the election, if any? And, what are they searching for in terms of if this candidate wins, this happens to them, those types of things?
Yeah, they're thinking about it in terms of policy, and they're thinking about it in terms of taxes. I think taxes is probably the taxonomy, pun intended, that is popping the most for us because that is of the most consequence to people, especially the investing class, right? There could be an extension of the tax cuts. There could be a deeper tax cut for wealthy Americans if Trump potentially wins, and there could be higher taxes for wealthy people if Harris wins, if that ever gets through. Most of the time, they're concerned about the impact of their own money, but we also have a lot of articles that we write and we update all the time: debt by president, spending by president, stock market performance by president. And you know this by being in the market a very long time, and the stock market almanac will teach us this as well. It doesn't really matter; it kind of evens out over time. Although policies can influence the direction of the market. Think about 2017 when Trump was first elected. Everyone thought the stock market was going to take a huge nosedive and we were going to go into recession. But those 2017 tax cuts really amplified the market for quite a while until COVID came along.
Are tariffs, is that a word that you see come up more and more often?
Tariffs is screaming like a toddler in a toy store that just dropped its ice cream. We see tariffs popping left and right. What are the impact of tariffs? What are the existing tariffs? What countries have tariffs against the U.S. right now? So that is always popping. And also the mechanisms behind tariffs in terms of the government agencies that control it and how that actually happens. How do tariffs actually manifest? So people are not just like, what does that definition mean? Because you know what? Definitions are really a dime a dozen. What we're finding is as we get closer and closer and people get a little bit more either tenuous about their own money or about their own decisions, they want to go deeper to actually understand the mechanisms of how these things work.
You know, we always wonder this, and we can look at our own data about our podcast. We can kind of get a sense from CNBC. But, you know, when the market is just grinding higher like it did, you know, for most of this year. Now, obviously, we had, you know, this little sell-off in July into August, and then, you know, it crescendoed. It V-bottomed, right? And we kept on going higher, and then we had a little bit of a sell-off in September. But I think this year we made like 47 new highs in the S&P 500, and I think we find that people get very complacent, right, in those sorts of markets. And so they're also getting a bit more complacent on the sell-offs, too. They've been trained to just buy dips, and that goes back to, you know, Guy, what was it in late 2018 when the market was selling off? It got down. How much did it in the
19.9%.
Yeah, and then obviously the Fed shifted, and there you go. It was off to the races. So I'm just curious, like in periods like this, where you had a level of complacency, where the market was just kind of going higher and higher, what do you guys see in that regard? You mentioned this anxiety index, but you also get like a euphoria sort of index too, or some sort of, you know, kind of vibe on that.
Yeah, but just like CNBC and just like all the great material you put out here and any website that's covering financial media, a slow market that grinds higher is not exactly a great recipe for a lot of traffic, right? Volatility is what drives a lot of interest in our business, no matter what you think about it. That's just what it is. When people get concerned, they start looking things up a lot more. But I was talking to Josh Brown about this recently, his terrific book, and I had him on my pod, and I know you guys know him well, about this notion of this relentless bid, right? This complacency of where every 2 weeks we're just putting money into our IRAs or our 401ks, those of us that are invested and have access to that. And he likened it to Warren Buffett. He's like, why do you think Warren Buffett became the greatest investor of all time and one of the smartest businessmen of all time? Because he has these businesses like insurance that just get a check every month. They just get a check every month. They just get a check every month. And that's kind of the way the market has become. And it's big vacuums taking in a lot of that money on the money management side. But I think that's just kind of the way we've been trained. And it's very hard for individual investors to pull money out of the market, especially in their retirement accounts or in that they just don't. It's harder to pull it out. It's hard to pull that trigger than it is to put a little bit more in, to put a little bit more in, to put a little bit more in.
So I could say you could look at it through two different lenses. The first lens is that's a great thing because obviously money's coming into the market regardless. The flip side of that coin is money's going in regardless, and it's looking past valuations, headwinds, geopolitical, anything you can basically name, the market looks past in a passive investing environment. So thoughts on that? Are there concerns? Do you see any concerns that, you know, passive investing by its very nature is creating a bit of I don't want to say bubble, but a little too much enthusiasm?
I have that concern myself as a passive investor. Now I have an advisor that does a lot of more active management on my family's behalf, but I'm concerned about that as well. And I'm concerned about that as an educator, as an investing educator, telling people that this is what to do, because I look back at 100 years of history, and no matter what, we kind of keep going up and to the right. Now, we've had dips, and there are good reasons for that. But when you think about the fact that there's a lot of money out there, right? And I'm not talking about sideline money. I'm just talking about money in general. From the investing in the wealth class have done very well. And it's very difficult for people to think about something other than doing this thing that we've been trained to do by the financial services industry, by our employers, by our government for years over years over years. And there's generational wealth tied up in that. It's hard to really move that out absent a big black swan event. And we know what happens when those happen. We've had some pretty big ones. And guess what? We're back. So I worry about it all the time. At the same time, what else are you going to do?
Right.
What is the alternative?
Well, I think about my own career. I entered the markets at a long-short hedge fund in 1997, and even then, you had this bubble forming in tech stocks, right? But it really wasn't. It took a while for other parts of the stock market to kind of really join the party, and I think that was kind of the last gasp, and you will. But the bear market that we had from the highs in 2000 to the lows in '02, that was excruciating. But since then, we have had nothing that felt that bad. And Guy, you can maybe give your 2 cents on that too. You get to the financial crisis, what was different there is there really was some existential risk. It really felt that way, but it didn't take that long to kind of, at least for the markets, to recover from that. And then you have COVID, which was a black swan event, to use the term that you just used. And we V-bottomed. We were back towards those prior highs in 6 months, and then it was a full-on bubble. And the correction for that was down 22.5% in 2022. Very orderly. You know what I mean? So I guess what I'm saying about that relentless bid, and people ask us all the time, and my answer usually is like, okay, come to us if you're into trading, if you're into stories, if you're into being tactical and this, that, or whatever. You want to learn about options, you want to learn about futures, all that sort of stuff. But most people, should not be doing that. You're a doctor, you're a postman, you're whatever the hell it is. You work, you have a job, and you should probably set it and forget it. So we're really dollar cost average guys too. I don't see a lot of risk in that if I go back and I think about my career of nearly 30 years. You're going to go through some periods that feel very uncomfortable, but the black swan events are few and far between.
They are, and guess what? The moral hazard is not really there anymore. We've also learned and watched time over time that the government comes in some capacity and either throws money all over it, floors interest rates, adjusts monetary policy, dislocates it in a way to take care of the problem, to get rid of the anxiety and the fear out there and make people feel like it's okay. It just compounds a problem later down the road. But as Warren Buffett has also said, that's a down the road problem. And if you worried about what was going to happen down the road and didn't invest, you've missed some of the greatest bull markets of all time. So, I worry about it too. At the same time, what is the alternative? And this is kind of what we've been trained to do.
Investopedia puts out some amazing articles, and there's a recent one, I think a couple weeks ago, 15 terms to be on the lookout for if the market were to head south. And words like bond yields, buy the dips, circuit breaker, contagion, correction, implied volatility. We'll put it in the show notes. But here's a question to you. I'm curious. Can these searches sort of portend in other words, if you start to see an uptick in these certain search words, historically, does that sort of lead to something, or is it just sort of an anecdotal thing and one does not necessarily lead to? In other words, if you see more and more people starting to search for contagion, is that typically ahead of something or in the wake of something?
Yeah, great question. And we've actually tracked the anxiety index, and we've had a research company do it against the VIX, and it precedes it. So people look first, then do. But also, it's mostly retail and individual investors that are looking for this stuff and coming to Investopedia, right? It is not the people that you were trained with or work alongside with or know in the industry that know what's going on. So, that word contagion might not pop until some institutional investor has said it on CNBC or put it in a note that somebody's picked up and it's made its way around Twitter, and all of a sudden it becomes part of the parlance. And then if individual investors or retail investors are making a move, it doesn't necessarily have the same impact as what institutions do, unless you get into the whole meme stock world where finally the tail was wagging the dog.
Final question from me. American Dream costs a certain amount of money according to your research. Over the last year, that's gone up significantly. What it was a year ago, it's probably up 30% or so from the prior year. So I think more and more people come to the realization that in order to get the American Dream, this is what I need to earn over my 23 to 65-year lifetime. So thoughts on the number, but more importantly, what the number comprises, what people are looking to do within that framework.
Yeah, great question. And we started to put a price tag on the American Dream last year because we noticed in 2023, we're always looking at the most popular terms throughout the course of the week, the day, the month, and also the year. We put out our terms of the year every year. And that term, American Dream, kept popping up. And it was one of the most trafficked terms of the year throughout the course of the year because we were dealing with massive inflation at that time. The Fed was trying to fight it with raising interest rates. And I think it wasn't because people were like, oh, what is that thing? By the way, it's a term that was coined by a writer, Winslow Odoms, I believe, in the 1930s in a book describing what was then the American Dream. But I think it was this notion that it was getting further and further apart, and it wasn't a thing for people anymore.
Wasn't
So
attainable.
It wasn't attainable. So we started to put a price tag on it. We refined the price. Last year, when we first did it, it was $3.3 million, but we refined some of the things that went in it and thought a little bit more this year about this can't be about the needs. It has to be about the wants, the aspirations. So we put a price tag on things in today's dollars, inflation adjusted, for owning a home, which over the course of 40 years, if you think about the median home payment and the mortgage you'll pay at current rates, that's going to be close to $1 million. If you're thinking about getting a new car every few years, that's going to cost several $100,000. The price of owning a few pets over the course of a lifetime, raising 2 kids, sending them off to a public university, right? We're looking at prices in those things. These are not things you have to do, right? These are not things you need to do. These are things you might want to do. Not everybody wants it. The price of your dream is different than mine, right? The price of your listeners' dreams is different, but you have to know what that price tag is for the reasonable expectations. Build your own dream. We have a calculator that we're building into that now, so you can build that number, which is basically what you do in financial planning. What is that goal number? Let's work back from it. That's what we're trying to do to people. So it's not the notion that we're restoring it. We're just saying, if you're wondering what it is, here's the things that we might reasonably want to do in a lifetime. And guess what? If you make the median income through 40 years of work, you're going to come up with something like $3.3 million. If the dream costs $4.4 million for the things we listed, there's the gap. Where's the gap going to get filled? It's going to get filled through investing. That's what we think. So that's what we're also trying to do, is show people you have to have your money working for you at the same time you're working, unless you are earning enough or you're partnering with somebody in a dual income, because dual income families make about, over a lifetime, about $5.2 million.
So when you think about bridging that gap, you think about getting to that American dream, so having that sort of financial freedom. One of the things that I think has been very clear to the three of us here is that there's different generations view that getting there in different ways. So I think about just the last 5 years and what happened in the second half of 2020, where all of a sudden there was a group of people that might not have had investable capital. They got it. They didn't have too many places to spend it. They put it in the markets. They became attached to certain stories, whether it was, GameStop or some of these other things, shitcoins in the crypto space. I mean, the smarter ones probably just put it in Bitcoin, which over the last, 15 years now, it's been a great investment, whatever you think of it, as an actual instrument and what its future is. And so a lot of these folks have become attached to some of these stories, in their narratives. Tesla is a great example. They've almost become religious. How has that changed for you in the way that you guys cover markets and cover stories, and then also cover individual investors, most importantly, because it sounds like, based on what you just said, you guys do a lot of work on that. You're trying to help people achieve those goals.
Yeah, well, we always know what the most popular stocks are among our readers and in the market, and it's not hard for anybody to know that. You can see what's most actively traded, and you know what they are. And every time we do the sentiment survey, we ask what their whole top 10 holdings are, and they look exactly like the S&P 500 or like most portfolios, right? We also ask them for what ETFs they hold and which ones they would hold for the next 10 years, and they're the biggest ETFs out there in the market, the Vanguards, right? The Schwabs, the Qs of it all. So we heard, as individual investors, people do a lot of that, but they love story stocks, and story stocks, like what happened during the meme stock mania, were great in terms of educating people about what was going on, but you also saw a lot of that hot money moving in and out. And even today, we have this market that's a little bit tenuous over the last few days, but we're seeing people starting to get a little bit more promiscuous, like looking for ways to short, looking for ways to maybe buy some penny stocks to ride them up or down. You can always see the promiscuity creeping in when the volatility rises. That's so interesting, but we also know the top 10, the top 25 stocks that people are most interested in. We write a lot of our news based on that, and a lot of our analysis based on that. But when we see something popping up, we're going to include it back into the mix, because when those stocks get the attention of both the financial media, which we're all a part of, and then retail investors, they become very interesting lessons in and of themselves.
I started this by saying you celebrated your 25-year anniversary, which again is remarkable. What are you excited about for the next, 5 or 10 years? Things that, you're working on, things that you never envisioned, maybe even a few years ago.
Yeah. we are always trying to find ways to reach our readers or the next generation of readers or the next generation of investors. So we went from being that dictionary or that encyclopedia where you could find the definition of everything and only ride that for a very long time. But that space is completely co-opted now by the robots and by the people that run those robots. So we have to find other ways to diversify our traffic and our audiences. And that has meant, the growth of the podcast, which is now in its 4th year, but also lots of new video work that we're doing right now for all different platforms and different ways to use that video to engage our readers, but also thinking about ways we can apply artificial intelligence, learn language models to us. We have 40,000 documents on our site. We've got a lot of data from readers over a very long period of time to understand the new ways people need to know how to learn. I'm interested in seeing how we can adopt those technologies because, we get this question all the time at Investopedia 30,000 times a month. How do I invest 10 grand? Which is why we put it in the survey. The answer for you is different for me. It's different for everybody. We need to know more, right? We don't want to do your financial planning, but we want to provide the best answers on the internet. And the ways that the best answers on the internet or social media or through a pod, the way they manifest are changing and they're different. And we want to be on the top of that wave, making sure we're catching it. So we got another 25 years in us. But we think just being this pure play educator about all things money is a great place to be. And like I said, when people I meet say thank you, it's one of the greatest feelings in the world. They're happy that Investopedia exists, and I'm super happy that I'm still working there.
We're going to say thank you because you rarely meet somebody who's so excited about the work they do and is so energized every day about it. Now, I don't obviously see you every day, but I know enough to know that you wake up and you're excited about the work you're doing, about the work you're going to continue to do, and what you're building there at Investopedia. So, Caleb, once again, thank you for joining us.
Thanks so much for having me.
Thanks, bud.
Thank you.